good going for these set of names as well.
Right, but back to the index, let's see some what are technical indicators indicating after the kind of move that we've seen today. We have Nilesh with us. Welcome, Nilesh. Talk to us about what you're seeing in terms of how the index is shaping up after today's move. It's obviously quite a decent move in trade today.
Very good afternoon to you, good afternoon everyone. So after today's move, we have seen multiple positive development. First of all, Nifty reclaimed its 21-day short-term moving average. Apart from that, Nifty also crossed its immediate hurdle of 25,000. And if you see on derivative front, we have seen today a tug of war kind of situation where put writers and call writers are very much active at 25,000 strike. So if Nifty sustains about 25,000 and move beyond 25,100, then call writers are forced to cover their short position. That will be a positive sign. Apart from that, if you see volatility index India weeks, which declined 4%, and currently it is very much in the comfort zone for the bulls, near about 13.5. So these are multiple factors that are supporting the bullish sentiment that we are witnessing today. Across the board, buying can be seen today, specifically in the bank Nifty, which is trading in line with the Nifty index and also cross its immediate hurdle of 56,000 as well. So comparatively, bank Nifty looks more stronger now compared to the Nifty index. But yes, the outlook looks positive in both Nifty and bank Nifty.
Okay, so would you buy the Nifty or the bank Nifty at the current levels? I mean, would you initiate a trade considering the fact that there is a weekend in the offing?
See, given the kind of setup that we are witnessing today ahead of a weekend, yes, it's a buying opportunity, specifically in the bank Nifty, because there we are getting more comfort now. Nifty, I would still wait for a decisive breakout about 25,100. But bank Nifty, yes, we are getting some bit of confirmation of a trend reversal from here. And bank Nifty can be bought with a stop loss below 55,900. Currently, it is at 56,150 and we are expecting a move towards 56,500 to 56,800. So that's the kind of level we might see in the coming week. With a very small stop loss, bank Nifty can be bought. But for the Nifty, I would still wait till the closing. If it manages to close about 25,050, that will be considered as a good close for the coming week.
Okay, what about specific stocks, Nilesh?
So I have a buy recommendation in Tata Consumer. This particular stock is looking strong today. We have seen a good reversal in this particular counter. We are expecting a follow-up move to continue towards 1120 to 1140 on the upside. So Tata Consumer can be bought for a price target of 1135. One can keep a stop loss at 1082. So that's a buy from my side. As of now, that's the only stock.
Okay, Nilesh, I'm curious to know where you see some of the banking names, especially the heavyweights. ICICI as well as HDFC are very close to their all-time highs, while the index itself is some way away, right? So how should we view the texture of a couple of these larger private sector banks?
See, out of this private sector bank heavyweights, ICICI remains our preferred bet on technical front. In fact, I wanted to include in my recommendation as well. But yes, given the kind of reversal that we have seen today, it's a kind of a follow-up move, I would say. It has surpassed its 50-day short-term moving average and looks like it is heading towards 1450 to 1480 or maybe a new record highs on the card. Since we are pretty much bullish on bank Nifty, so these are the stocks that are likely to lead from the front. So ICICI Bank is a buy for a short-term price target of 1450 to 1480. One can keep a stop loss below 1410.
Nilesh, we were highlighting some of the movers and shakers today, and it seems that the textile names, all of them, are weaving some strong gains today. I mean, we marked, of course, a Sangam or a Pearl Global or a Himmat Singha. It's a small bucket, but weaving some strong gains today. Is there a trade in any of those?
This, like you mentioned, is a very small pocket, and out of this, we are really not tracking any of this stock. But looking at the technical structure of Himmat, this particular stock is witnessing a 4% spurt today. And good part is that it has found a very strong support near about 135. That's the kind of a multi-month support it has taken. So a pullback move can be seen towards 150 levels on the upside. So with a stop loss below 137, this particular stock can be bought. But since we have already seen a spurt today, better to wait for some bit of decline.
Okay, so that's on Himmat Singha, but let's go across. We also have Devin Choksi joining the conversation, Managing Director of DR Choksi Investment Managers. Welcome, good afternoon, sir. It's been a while, so good having you. So I want to first start off by understanding how you're viewing the markets. We've seen over the last couple of months several pieces playing out in the geopolitical arena, but you also have a very strong rally that we've seen since April or even since March for that matter. So how do you view it at this point, and where are we in terms of valuations? Give us some perspective.
Yes, Sarsh, good afternoon.
Good afternoon.
I'm glad to be on the show with you today. Well, I believe that I think the overall environment remains quite conducive for us, save and except the recent turbulence that we have started in this month with the fresh war between Israel and Iran. I think that's where probably I think the concerns are, where the oil prices have shot up, supply chain logistics have probably gone crazy, and the industry is finding it difficult to basically manage this kind of complex situation because of the sudden developments which have happened. But leave that part little aside. I think minus this situation, we are pretty much comfortable as an economy, A, with the inflation, B, with the interest rate, C, I think with the tax collections that we are seeing, D, along with, I think we are seeing the growth in the economy, both on the infrastructure side of the activity where government is a big time spender, and the industry side of the activity where the industry is investing money, though I think a free cash flow is basically used for investing. So to a greater extent, I believe that I think we are moving in a very nice direction. It promises to produce somewhere around 15 to 17% kind of growth in earnings, even in the current year and thereafter. So given that situation, I think one is remaining quite comfortable with the market. However, I think more importantly, the momentum is very, very strong in small and mid cap in particular. Also, I think the fact that I think some of the large investors have started putting more money into the large cap as well. So there the momentum has started building up. But that's a typical sign of high conviction, where in the bull market, people would like to participate maximum, they trade maximum, they churn their portfolio maximum. But otherwise, I believe that I think in plenty of pockets, given the price correction in between, I think there should be or there will be an opportunity to buy some of the stocks in the portfolio.
So maybe a bit of a contra in terms of the question, but you know, generally when there is a very perfect alignment of economy, the way the markets have moved, you don't get extremely healthy returns, at least in the near term. Do you believe that we are at that stage, or do you believe valuations provide enough room for comfort despite this very blue sky kind of economy on the Indian macro front that we are seeing?
Absolutely, I think do agree with you that when the economy's all indicators are in a mature stage, I think you don't get enough amount of deep values in the marketplace. Fully agree with you. However, it is at this point of time, I think your skills are required to pick up the stocks based on, I think, the underlying value proposition that they offer. 2 or 3 areas wherein probably I think you get more comfortable. A, market does offer opportunity, and I think use some kind of significant price correction in between. Suppose if 25,200 Nifty is seen as a hurdle for technical analysts, I think they may probably push the index down for a variety of reasons to buy, say, 500 to 1,000 points. That could be a buy opportunity in at least some of the select stock. Second way to look at this entire opportunity is, I think, where the opportunity is getting built up. For example, I think after this war-related destruction, when the construction starts happening, the likes of L&T, likes of metal companies would probably, I think, start participating into the entire program. And that's where I think the business condition starts opening up. So suppose if this conviction is high, then nothing wrong with the metal commodity stocks at this point of time, as long as you are not in a momentum trading. If this is available, I think it could be a contra buy opportunity as well. So yes, we follow some of the approaches which are prudent approach while looking at the market from the long-term perspective, of course.
Okay. Devin bhai, good afternoon and glad to be talking to you. I would love to know, how do you think about oil sensitives in the current scenario? We are not at 65, which was a sweet level, but this conflict has still not led oil to 85 or above. What do you do with oil sensitives, both upstream and downstream?
Yes, Neeraj, good afternoon. Happy to talk to you as well. Um, I think in this kind of momentum, nobody will be right, nobody will be wrong, because I think this particular commodity has a typical character. I think given the kind of situation in which we are in the global economy, is a conflict around, I would think that I think yes, it will not be a complete handle for even the refiners or the users of the oil, because I think they may probably be lucky to have their forward contracts getting executed at a cheaper price in current month or next month. But in subsequent period, if they have to have, I think the new contracts getting executed, it would be, I think, probably bought at current price. And that's where I think you are going to see the fluctuations. That's where you're going to see the ups and downs in the profit picture of some of these companies. Frankly, I think though we remain invested in companies like Reliance, which is the largest user of crude oil, we rely more on its ability to process the refining products and process the petrochemical products and generate the alpha on the top of it. But pure play commodity crude, no, I don't think that I think we have a complete handle on it, and neither we have investment in those companies because we don't understand the volatility and fluctuation in the crude.
Okay. Okay. Would you believe that there is a, how do I say, a bit of a risk of warranted at the current time as a result of that, Devinbhai? Because retail futures longs are at record levels, the MTF leverage book is above 82,000 crores again, and geopolitics stays. It is also the weekend wherein more news will come in. Is it better to be prudent and have small positions, or would you be comfortable trading in the market as if it is business as usual?
So I think take the first point first, no leverage. I think if you can afford to have the position, I think with the investment amount, I think which is your saving money, then you are justified. But I think if you are taking the leverage because the momentum is strong, I think that leverage is going to be harmful. That's what my personal take would be. So I would stay away from leverage, be it in any form, be it MTF, be it a loan against shares, etc. Those kind of leverages are harmful, according to me. On the other side, I think if you are definitely wanting to be in the market, stay with quality. That's the second approach that we would keep. In fact, I think that would be the first approach that we would keep. That keep your investment in quality stocks, because even if for some reason the market comes down, stock price comes down, I think those companies would have ability to bounce back in due course of time. So stay with quality. That's the second approach that we would keep in this kind of situation.
Okay. So stay with us, because there's one stock and one particular script which is in the eye of a storm since the last couple of days. There seems to be some trouble brewing for Dream folks. Major banks, card networks reconsider their partnerships with the company, reportedly aiming to bypass aggregators like Dream folks for airport lounge access. Could this be a start of a nightmare for the company, is really what we're trying to dig into. And Mahima's come with that analysis. Mahima, over to you.
Right, so recovery is probably because the company has come out and clarified, but let's first take a look as to what's happening exactly there. Now, in terms of what's not working for the counter, couple of things. Banks might be ending partnership with the counter. There's stagnant operating profits plus declining profitability overall as well. In terms of lease liabilities that are increasing, plus they're not able to pay their creditors on time because overall trade payables are increasing for the counter. In terms of other aspects, there's declining net cash flows plus working capital days are increasing for the counter as well. There's also FI and DI that are cutting their stakes, and there are structural changes by the banks which might hamper the working for Dreamspoke. Now let's take a look at each of these points in detail. In terms of stock performance, the stock is currently trading 32% below its 200-day moving average and 40% down over the last 6 odd months, plus 27% down since its issue price, which was at 326. So stock performance not faring very well for the company. In terms of where profitability stands, and of course, before we go on to that, banks ending partnerships, major Indian banks and card networks might move away from the counter is the news that we got from PTI. And this includes banks like ICICI Bank, Axis Bank, as well as MasterCard. This has happened because the company witnessed a temporary disruption in September 22 of 2024. And sudden closure of at least 49 lounges across 34 airports took place because of this. Of course, after this, company did did come out and clarify that negotiation is a part of their business and this is an ongoing thing. But in terms of how this can impact Dreamfolks as a whole, because 93% of their revenue comes from launch services and 7% comes from non-launch services. Now, moving on to the profit side of things, well, EBITDA has remained stagnant in the past 3 years. It's hardly gone from 104 crore to 102 crore. It slightly declined there. In terms of PAT, that has gone down from 72 crores to 65 crores in the past 3 years. In terms of profitability ratios also, that have come down significantly. Your ROE has come down from 60% to 24% mark and 55% of ROCE to around 22% of ROCE. Moving on to the next slide, there's lease liability, which has also gone up for the counter from around 7 crore to 10.4 crore, but trade payables have nearly doubled from 71 crores to almost 165 crores for the counter. So that means that there is lag in terms of paying the creditors as well. In terms of net cash flow, FY23, their net cash flow stood at around 18 odd crores, which has come down to 3 crores in FY25. So that is also at a deteriorating end. Working capital days have increased from 31 to 64. So here also working capital days have doubled for the counter. In terms of their overall FI and DI picture, March 23 FIs were holding around 11% stake in the company, which has come down to almost 0.98%, so hardly 1% stake held by FIs now in the counter. The DI stake in March 23 was roughly 8.6 odd percent, which has come down to 3.5% in March 24. So even that has come down, and even promoter stake has slightly come down from that 67 mark to 65% mark. Now, structural changes that could impact the company, this includes your banks that are now replacing blanket usage with spend-based model for lounge access. That means you'll be able to use lounge only after a certain credit spend, so that could impact. And of course, lower credit card penetration in India could be a structural change that could impact the company. So all of this combined together might pose turbulence on Dreamfolks as a whole.
Well, thank you for that, Mahima. Quite a detailed one. Devin, there was one section of the market which, presumably called this literally a monopoly business of sorts for a very long period of time, commanded premium valuations. One, is this, in your sense, a business where there's a very strong moat that Dreamfolks has and therefore warrants a look? Or do you feel that the concerns are very real?
Well, I think when I studied this particular company, couple of things I think which I observed and I think they remain valid even today. I saw the threat of disintermediation, and that's what exactly I think is now playing out. Why would not the bank directly go out to the lounges and tap their customers and I think the business? They have adequate amount of digital reach to do so, and that's where the customer may probably find it I think quite effective as well. Being an aggregator, they themselves, I don't think that I think beyond a point, I think they would end up adding some values. That is my viewpoint at that point of time too. I'm not too sure whether I think they're adding significant amount of values which the banks themselves cannot. In fact, I think in this particular era of digital reach, where each and every single entity with an intermediary is threatened because the last mile connectivity is absolutely established, if not today, tomorrow, given the kind of technology reach that one is getting. So in my viewpoint, I think the business model will have to get reinvented, and somewhere I think we'll have to see whether I think they add up some kind of a better valuation in the country, in the revenue equity. Currently, I think the revenue equity is quite lopsided, as I also heard from Mahima. So I think that we'll have to wait and see for a period of time. I think till the time they probably clear new path, I think as far as the revenue model is concerned.
Okay. Nilesh, do you have a view with regard to this one? I know it's you don't have a very long time chart for this one, but is there a technical view that you have with regard to a Dreamfolks?
See, Dreamfolk, we saw it made a high in the year 2023 of roughly around 840. And since then, we have seen a constant decline. Whatever pullback in between we saw that got sold into, the structure is still looking weak. From here, if at all you see any pullback towards 250, 270, I think that could be a good opportunity to exit your long position. The structure is still hinting that we may see further downtrend to continue, and stock may revisit the levels of 220 to 200 as well on the lower side. So better to stay away. It's not advisable to take any contraband at current level till the time we don't get any confirmation on a long side. So it's an avoid.
Okay. Devenbhai, before we wrap up, a word on NBFCs maybe. I mean, of course, yesterday's directive from the Reserve Bank, constructive for the power financiers and infra providers. But in general, RBI's recent moves seem to be very conducive non-banking financial companies. Are you of the same view, and are you a buyer even at the current valuations in NBFCs?
So I think I have categorized, NBFCs into a few parts. The large NBFCs which are catering to the pure focus retail, I think are the ones who are basically having a relatively better say as far as their lending ability is concerned to the customers. The pure focus, I think typical asset class connected NBFCs like gold asset class, I think are the ones which are quite vulnerable to the kind of environment in which they operate due to the fluctuations involved in it. The smaller NBFCs in particular, which are lending at a significantly high rate of interest, I think are the ones who are basically most vulnerable in a given situation, because they will also have significantly large amount of NPAs to field about. And last but not the least, I think the infrastructure NBFCs like power finance companies, I would think that they have a relatively better model to talk about, because they are a large size companies. They have, a whole story to run as far as the power utility business is concerned. Not for now, but for next 10 years, given the program that government in India is executing. So in my viewpoint, they would be relatively good. Fortunately, they are not so expensive as compared to many other small NBFCs are. So I think we would probably remain more comfortable with likes of PFC, RFC, REC, and also some of the bigger names in the consumer finance business, likes of Bajaj, Geofin, or for that matter, among others like HDB, which is now coming up with IPO in some time.
How do you like, because you brought up HDB, curiosity, how do you like the price at around maybe 3.3 times post money?
Slightly expensive though, if you want to put it that way. But my take is that after getting separately listed, there has to be enough amount of business to talk about by the company. Something which under the fold of the bank, they couldn't do. Possibly after getting listed separately, they will probably move faster. The way in which Bajaj Finance has been moving, that is a good expectation from HDB, given the kind of tag degree that they are enjoying. So yes, slightly expensive at this point of time, but I would think that there would be enough takers for quality product or quality paper in their portfolio.
Okay. Thank you so much for coming and speaking with us. So it's always good chatting with you, getting that perspective, Devenbhai. Let me do a thing. Let me also slip into a very, very short break.
Just before that break, sorry. I know it's